Welcome to the deep dive. Today, we're going to explore Morgan Housel's The Psychology of Money,
Okay.
but not in the way you might expect.
Right.
We're going beyond those basic budgeting tips
Yeah.
and diving into the often overlooked why behind our financial decisions.
Interesting.
You've shared some fascinating excerpts from a blog post summarizing Housel's key ideas,
Okay.
and we're going to kind of unpack those together.
Sounds good.
By the end of this deep dive, you'll have a new understanding of the forces at play in your own financial life,
I like it.
hopefully leading to smarter, more informed choices.
Yeah, Housel's approach is all about recognizing that money isn't just about numbers.
Right.
It's deeply intertwined with our emotions, our experiences, and even our personalities.
The blog post jumps right into this with the idea that no one's crazy when it comes to money.
Okay.
Essentially, everyone's financial decisions make sense when viewed through the lens of their own unique experiences.
It's like those who came of age during the Great Depression. They often carried a sense of scarcity and frugality throughout their lives, even when their financial situation improved.
Yeah.
Similarly, imagine someone who witnessed their parents lose everything in a market crash.
Oh, wow.
That experience could easily lead to an aversion to risk,
Yeah.
even if statistically taking calculated risks might be beneficial in the long run.
It makes you realize that our financial choices aren't always purely rational.
Right.
We carry these invisible scripts based on our past, sometimes without even realizing it.
Exactly.
And that's where understanding the psychology of money comes in. It's about becoming aware of those subconscious influences and making more conscious, intentional choices.
And sometimes it's not just our personal experiences that shape our financial decisions, but also just plain luck.
Luck.
The blog post dives into this with the concept of luck and risk,
Okay.
arguing that both play a huge role in financial outcomes.
The story of Bill Gates is a perfect example.
Oh, yeah?
Imagine being a teenager in the 1970s with unlimited access to a computer.
Wow.
Something almost unheard of at the time.
Right.
Gates just happened to attend one of the few high schools with this resource,
That's good.
giving him a massive head start in the burgeoning world of software.
Yeah.
Would he have achieved the same level of success without this lucky break?
It's impossible to say for sure.
It's humbling, isn't it?
Yeah.
Makes you wonder how many brilliant minds are out there who just haven't had that same stroke of luck.
I know.
And it also highlights the flip side of that coin, risk.
Risk.
Even with talent and hard work, sometimes circumstances just don't align.
Absolutely.
And that's where understanding risk tolerance comes in.
Yeah.
How comfortable are you with the possibility of things not going according to plan?
Right.
It's a crucial question each of us needs to answer for ourselves.
It is.
Because let's face it, sometimes, even when we seem to have it all, that human desire for more can take over.
More.
This is where the blog post takes a darker turn, with the stories of Rajat Gupta and Bernie Madoff.
Oh, yeah, those guys.
These were individuals who seemingly had achieved incredible financial success.
Yeah, they had it all.
But still risked it all.
They did.
Due to an insatiable desire for never enough.
These stories highlight the danger of not defining enough for yourself.
Enough.
When is it enough?
Right.
Is it a specific number?
Yeah.
A certain lifestyle? Or a feeling of security?
Yeah.
Without that internal compass, it's easy to get caught up in a never-ending chase for more.
Right.
Which, as these cautionary tales show, can have devastating consequences.
It makes me think about the psychology of greed.
Greed, yeah.
Why is it that sometimes, even when we have more than we could ever need, we still crave more?
Right.
What drives that insatiable desire?
It's a complex question.
Yeah.
With roots in evolutionary psychology, social comparison, and even our own personal insecurities.
Interesting.
But the key takeaway here is that defining enough is crucial for both financial and emotional well-being.
And this brings us to a concept that I find both fascinating and incredibly powerful.
Okay, what's that?
The idea of compounding.
Compounding, yeah.
The blog post really drives home the point that consistent long-term growth can lead to astonishing results.
It can.
Even if you don't start with a huge sum of money.
Imagine this.
Okay.
You start investing just $500 a month at age 25.
$500 a month.
With an average annual return of, let's say, 7%.
7%.
That seemingly small investment could grow to over $1 million by the time you retire.
That's amazing.
The key is to start early and let the magic of compounding work its magic.
It's amazing how quickly those gains snowball over time,
Yeah.
especially in those later years. It
Yeah.
really highlights why delaying saving even by a few years can make such a big difference.
Exactly.
It's like planting a tree.
Planting a tree.
The best time to plant it was 20 years ago,
Uh-huh.
but the second best time is today.
I like that.
Every dollar you invest today has the potential to multiply exponentially over time.
It does.
But of course, as the blog post points out, getting wealthy versus staying wealthy are two very different things.
Two very different things.
It's not just about generating returns,
Right.
but also about avoiding those catastrophic mistakes that can wipe out years of progress.
Housel puts it perfectly.
Okay.
If I had to summarize money success in a single word, it would be survival.
Survival.
In the world of investing, it's not always about hitting home runs.
Right.
Sometimes simply avoiding strikeouts is the key to winning the game.
So it's not just about chasing the next big investment opportunity, but also about having a solid foundation,
Right.
managing risk effectively, and making decisions that protect your long-term financial well-being.
Long term.
I like that analogy of avoiding strikeouts. It really emphasizes the importance of playing the long game.
It does.
But sometimes those big wins do come along.
They do.
And that's where the concept of tails you win comes into play.
Tails you win.
This concept is all about understanding the power of tail events.
Okay.
Those rare, unpredictable events that can have a massive impact on our lives.
Right.
Both positive and negative.
Both.
Think about the rise of the internet,
Oh, yeah.
the 2008 financial crisis, or even a global pandemic.
Wow.
These are events that no one could have predicted with certainty,
Right.
but had a profound impact on the world.
I did.
So how does this concept of tail events apply to our own financial decisions? It seems like something so massive and unpredictable would be impossible to plan for.
That's true to a certain extent. We can't predict the future, but we can acknowledge that these unexpected events happen and will continue to happen. In investing, this means accepting that you won't be right all the time.
So it's not about trying to perfectly time the market or predict every up and down.
Exactly. It's more about positioning yourself to benefit from those rare but significant tail events that can generate outsized returns. Think of it this way. You don't need to win every hand of poker to come out ahead. A few well-timed, calculated bets can make all the difference.
That's a helpful analogy. It takes some of the pressure off feeling like you need to constantly be chasing the next hot stock.
It makes me think about another idea from the blog post, the concept of freedom as being the ultimate goal of financial success.
That's really the heart of it, isn't it? True wealth isn't just about a big bank account or a fancy car. It's about having the freedom to control your time, to make choices aligned with your values, and to pursue the things that bring you joy and fulfillment.
It's about having options, right? The option to walk away from a job you hate, the option to spend more time with loved ones, the option to travel the world, or to pursue a passion project without worrying about the financial implications. Those are the real dividends that money can pay. And those dividends are often overlooked in our culture that often equates wealth with flashy spending and material possessions. But as the blog post astutely points out, wealth is what you don't see.
I love the analogy used in the blog post. Rich is a current income, nice cars purchased, wealth is hidden. It's a powerful reminder that true wealth is often built quietly and steadily through saving, investing, and making smart choices over time.
Think of it like an iceberg. The tip of the iceberg might be what people see, the house, the car, the vacations. But the real mass, the real substance of that wealth, lies beneath the surface in the investments, the savings, the financial security that provides a solid foundation.
Which brings us back to the importance of saving. The blog post really hammers home the point that saving, regardless of income level, is the one factor you can control on your path to financial well-being. It's not always exciting, but it's essential.
And it doesn't have to be a huge amount. Even small, consistent contributions can make a big difference over time, especially when combined with the power of compounding. It's about building those good financial habits early on and making saving a non-negotiable part of your routine.
Now, I know life rarely goes exactly as planned. Unexpected expenses pop up, goals change, and sometimes we make mistakes. This is where the idea of room for error comes in.
Absolutely. Having a margin of safety in your financial planning is crucial. This would mean having an emergency fund to cover unexpected expenses, not overextending yourself with debt, and even being willing to adjust your plans as needed.
So it's not about trying to perfectly predict the future, but about creating a plan that's flexible enough to withstand those inevitable bumps in the road.
Precisely. It's like building a bridge. You want to engineer it to withstand not just the expected load, but also potential stress factors like strong winds or even earthquakes. In financial terms, that means having a plan that can weather unexpected job loss, market downturns, or even a global pandemic.
Speaking of changing plans, the blog post brings up a really interesting psychological phenomenon called the end of history illusion. Essentially, it's the human tendency to underestimate how much our goals, desires, and priorities will change over time.
It's a fascinating concept, isn't it? We often make decisions based on who we are today, assuming that our future selves will want the same things. But the reality is that we're constantly evolving, and our priorities are likely to shift as we age, experience new things, and gain new perspectives.
It's like that saying, the only constant is change. And yet, we often fall into the trap of thinking that who we are today is who we'll always be. How can we avoid falling prey to this illusion when making financial decisions?
It starts with awareness. Simply acknowledging that our future selves might have different priorities than we do today can make a big difference. This might mean avoiding locking ourselves into rigid long-term financial commitments that could limit our options down the road.
So, building in some flexibility to adapt as we grow and change is key.
Exactly. And this applies not just to our financial plans, but also to our mindset around money. Be open to learning new things, adapting to changing circumstances, and refining your financial goals as you go.
Now, the blog post doesn't shy away from the realities of investing, especially when it comes to the often hidden costs. It's not always sunshine and rainbows, right?
That's right. The blog post talks about the nothing's free principle, which I think is incredibly important to understand. Investing comes with inherent costs, and those costs go beyond just the fees you see on your brokerage statement.
So, what are some of those hidden costs that we should be aware of?
Well, one of the biggest is volatility. The market goes up and down, and those fluctuations can be emotionally draining, even for seasoned investors. There's also the opportunity cost of tying up your money in investments. And let's not forget about the time and energy it takes to research, manage, and stay informed about your investments.
So, it's not just about the potential returns, but also about the emotional and mental toll that investing can take.
Exactly. And the blog post makes a really interesting point about reframing these costs as fees rather than fines. It's a subtle shift in perspective, but I think it's a helpful one.
So instead of viewing market downturns as punishments, we should see them as the price we pay for the opportunity to participate in the long-term growth potential of the market.
Precisely. It's about shifting our mindset from one of fear and anxiety to one of acceptance and understanding. Investing comes with inherent risks, and those risks are simply part of the journey.
Now, we've talked a lot about the importance of making rational, informed decisions about money, but the blog post also cautions against striving to be coldly rational all the time.
That's right. Housel makes the point that we should aim for reasonable rather than rational when it comes to financial decisions.
Why is that distinction important?
Because we're human beings, not robots. We have emotions, we make mistakes, and our decisions are often influenced by factors beyond pure logic. Trying to suppress those human elements entirely can actually be counterproductive.
It's like trying to hold a beach ball underwater. Eventually, it's going to pop back up. So it's about finding that balance between logic and emotion.
Exactly. Recognize that your emotions play a role in your financial decisions, but don't let them completely dictate your choices. Aim for a balance between your head and your heart.
This makes me think about the next concept from the blog post: the danger of relying too heavily on past data when making financial decisions.
That's right. The blog post highlights what Housel calls the historians as prophets fallacy. Just because something worked in the past doesn't guarantee it will work in the future.
Especially in a world that's constantly changing, right? What worked in a pre-internet era might not be relevant in today's digital landscape.
Precisely. The world is constantly evolving, and so are the financial markets. Blindly following historical trends without considering current conditions and potential disruptions can lead to some pretty bad outcomes.
So it's about being adaptable and recognizing that the financial landscape is constantly shifting.
Absolutely. It's about staying informed, being open to new information, and being willing to adjust your strategies as needed.
Now, one of the things I've learned over the years is that it's easy to get caught up in comparing ourselves to others, especially when it comes to money. But the blog post cautions against taking financial cues from people who are playing a different game than we are.
That's such an important point.
Yeah.
We often fall into the trap of comparing our financial situation to others, but it's rarely a fair comparison. Everyone has their own unique financial goals, risk tolerance, and time horizon.
It's like comparing apples to oranges. What works for someone else might not work for you, and vice versa.
Exactly. Focus on running your own race, not someone else's. Define what success means for you and make financial choices that align with your own values and aspirations.
Now, I'm naturally a pretty optimistic person, but the blog post brings up an interesting concept called the seduction of pessimism, suggesting that pessimism often sounds more persuasive than optimism.
It's true. Pessimism tends to focus on recent events and potential risks, which can feel more immediate and tangible than the long-term benefits of optimism.
It's like the classic news bias toward negativity. Bad news sells.
Exactly. And that negativity bias can creep into our financial decision-making if we're not careful. We start focusing on all the things that could go wrong instead of focusing on the potential for growth and opportunity.
So how can we cultivate a more balanced perspective, one that acknowledges risk without succumbing to undue pessimism?
It's about recognizing that the future is inherently uncertain, and both positive and negative outcomes are possible. Don't ignore the risks, but don't let them paralyze you either. Focus on what you can control, make informed decisions, and have a plan in place to mitigate potential downsides.
Now, one final idea from the blog post that really resonated with me is the power of stories. Housel argues that stories often trump statistics, especially when it comes to money.
This speaks to the emotional side of investing. We're drawn to narratives that confirm our existing beliefs and hopes, even if those narratives aren't supported by data or rational analysis.
It's like those get-rich-quick schemes that prey on people's desire for easy wealth. The stories they tell are often compelling, even if they're ultimately unrealistic.
Exactly. It's crucial to be aware of this tendency and to ground your financial decisions in sound principles and objective analysis, rather than letting emotions or appealing narratives cloud your judgment.
That's such an important reminder. It's about thinking critically and not letting ourselves be swayed by slick marketing or promises that sound too good to be true.
Absolutely. It's about being discerning consumers of financial information and making choices aligned with our long-term goals and values. Don't get swept away by a good story without first examining the facts and considering the potential risks.
This has been such an eye-opening discussion. We've really delved into the psychological complexities of money, from the biases that shape our decisions to the strategies for building lasting wealth and finding true financial freedom.
It's been a pleasure exploring these ideas with you. I think the key takeaway here is that our relationship with money is deeply personal and influenced by a complex interplay of factors, including our past experiences, our emotions, and our values.
Absolutely. Understanding those influences is key to making sound financial decisions that align with our goals and aspirations. It feels like we've covered so much ground already, but, this blog post is packed with wisdom.
It is.
Before we wrap up this deep dive
Okay.
into the psychology of money,
All right.
let's shift gears
Okay.
and talk about some actionable takeaways.
Actionable. Yeah.
What are some concrete steps our listeners can take
Okay.
to apply these principles to their own lives?
One of the most powerful concepts we've discussed is the importance of defining enough.
Enough.
It's so easy to get caught in the comparison trap, always striving for more.
Right.
But that can be a recipe for perpetual dissatisfaction.
I know, I've definitely fallen into that trap myself. It's like there's always someone else out there with a bigger house, a fancier car, or a more exotic vacation.
Uh-huh.
It's easy to lose sight of what truly matters
I know.
when we're constantly bombarded with images of other people's seemingly perfect lives.
And that's why it's so crucial
Right.
to take a step back and define what enough looks like for you personally.
Define enough.
It's not about keeping up with the Joneses or trying to impress others.
Mhm.
It's about creating a life that feels fulfilling and aligned with your values.
So how do we actually go about defining enough?
Well,
It sounds great in theory,
yeah.
but it feels like a pretty abstract concept to put into practice.
It starts with introspection.
Okay.
Take some time to reflect on your values, your goals, and your priorities.
Values, goals, priorities.
What truly brings you joy and fulfillment?
Joy and fulfillment.
What kind of legacy do you want to leave behind?
Like this year.
What would your ideal day look like if money were no object? Once you have a clearer understanding of what's important to you, you can start making financial choices that support those aspirations.
I love that idea of picturing your ideal day.
Yeah,
It really helps to strip away all the external pressures and focus on what truly matters.
it does.
And once you have that clarity, it becomes easier to let go of those things that don't align with your vision.
Exactly.
It's about making conscious choices that move you closer to your goals,
Right.
rather than simply reacting to external pressures or following the crowd.
Now, one thing that can be really helpful in aligning our financial choices with our values is creating a budget.
Oh, the dreaded B word.
I know, but it doesn't have to be a restrictive or punishing exercise.
So a budget's not a bad thing.
No, it's not a bad thing.
A budget is simply a tool for gaining awareness
Okay.
of where your money is going
Right.
and making sure it's being allocated in a way that supports your goals.
Yeah.
It's about making informed choices
Right.
rather than simply spending mindlessly.
And technology can be a huge help in this area.
Technology.
There are so many great apps and online tools these days
Yeah.
that can automate your budgeting process and make it much less painful.
It seems like there's an app for everything these days.
There is.
Now, one of the key themes that runs throughout this entire blog post
Okay.
is the importance of thinking long-term.
Long-term thinking.
Whether we're talking about saving or investing or even defining our goals,
Right.
it's all about playing the long game.
And there can be a real challenge in our instant gratification society.
Yeah, I think so.
We're constantly bombarded with messages that encourage us to spend now, worry about the consequences later.
Spend now, worry later.
But when it comes to building wealth and achieving financial security, patience and discipline are essential.
Patience and discipline.
It's like that famous marshmallow experiment, right?
Yeah, the marshmallow experiment.
The kids who could resist the temptation to eat the marshmallow immediately
Uh-huh.
ended up with a bigger reward in the end. Delayed gratification is a crucial skill for financial success.
Delayed gratification.
It's about being willing to forego immediate pleasures
Right.
in pursuit of long-term goals.
Now, speaking of long-term goals,
Okay.
investing plays a huge role in building wealth over time.
It does.
But it can also be a really intimidating topic, especially for beginners.
It's true. There's a lot to learn about investing,
Yeah,
and it can feel overwhelming at first.
it can.
But remember, you don't have to become an expert overnight.
Right.
Start with the basics. Educate yourself gradually.
Okay.
And don't be afraid to ask for help from a financial advisor if needed.
And one of the most important things to understand about investing is the concept of risk.
Risk. Yeah.
We've talked about this in the context of tail events and room for error.
Right.
But it's worth reiterating that every investment comes with some level of risk.
Absolutely. There's no such thing as a guaranteed return in investing.
No guaranteed return.
And understanding your own risk tolerance is crucial before making any investment decisions.
So how do we determine our own risk tolerance?
Right.
Is it something that's set in stone, or can it change over time?
Risk tolerance is influenced by a number of factors,
Okay.
including your age, your financial goals, your time horizon, and even your personality.
So many factors.
They're not necessarily fixed, and it can evolve as your circumstances change.
That makes sense.
Someone in their 20s with a long time horizon until retirement
Okay.
might be more comfortable taking on higher levels of risk
Uh-huh.
than someone approaching retirement who needs to preserve their capital.
Yeah, makes sense.
And that's why it's so important to
Right.
periodically reassess your risk tolerance
Okay.
and make sure your investments are still aligned with your overall financial plan.
Now, when it comes to investing,
Yeah,
one of the biggest decisions we face is asset allocation.
asset allocation.
Deciding how to divide our money
Okay,
between different types of investments,
yeah.
like stocks, bonds, and real estate.
Asset allocation is crucial because it plays a major role in determining both your potential returns and your level of risk.
Returns and risk.
A well-diversified portfolio can help to mitigate risk and smooth out those inevitable market fluctuations.
Diversification.
Diversification.
That's another one of those fundamental investing concepts that's worth repeating.
It is.
Don't put all your eggs in one basket, right?
Exactly. Spreading your investments across different asset classes, industries, and geographic regions can help to reduce the impact of any single investment performing poorly.
Now, we've talked a lot about the importance of making rational, informed decisions about money.
Well, yeah.
But the blog post also acknowledges that we're not always rational creatures.
That's right.
Especially when it comes to our finances.
Especially when it comes to our finances.
We're influenced by emotions, biases, and those invisible scripts we've developed over time.
Yeah, those invisible scripts.
And sometimes those emotional impulses can lead us to make financial decisions that aren't in our best interests. It's like that saying, Money and emotions don't mix well.
Right.
We've all been there, right?
Oh, yeah?
Making an impulsive purchase we later regret,
Mm-hmm.
or selling an investment out of fear at the worst possible time.
Oh, man, I've done that.
And that's why it's so important to be aware of those emotional triggers
It is.
and to have strategies in place
Throughout.
to mitigate their impact on our financial decisions.
So true.
So what are some practical tips for keeping our emotions in check when it comes to money?
One helpful strategy is to create a cooling off period
A cooling off period.
before making any major financial decisions.
So before making a decision, just take some time.
Take some time.
Give yourself time to think things through rationally
Uh-huh.
and avoid making impulsive choices driven by fear or excitement.
That's it.
I love that idea.
Yeah.
It's like taking a deep breath before responding to an angry email.
I like that analogy.
It gives you a chance to calm down and approach the situation with a clearer head.
And sometimes it can be helpful to talk things through with a trusted friend, family member, or financial advisor.
Talking it out.
Getting an outside perspective can help you identify any blind spots
Right.
or emotional biases that might be clouding your judgment.
Now, one of the things that can be particularly challenging emotionally
Okay.
is dealing with market volatility.
Market volatility.
Oh, yeah. We've talked about reframing those ups and downs
Yeah.
as fees rather than fines.
Fees, not fines.
But it's still easier said than done when you see your portfolio balance dropping.
It's true. Market fluctuations are inevitable,
Mm-hmm.
and they can be stressful,
They can.
even for experienced investors.
Right.
But remember, investing is a long-term game.
Long term.
Short-term fluctuations are just noise.
Noise.
Focus on the big picture and your long-term goals,
It's like riding a roller coaster.
right? Like a roller coaster.
There are going to be ups and downs along the way.
There are.
But if you keep your eyes on the horizon,
Uh-huh.
you'll eventually reach your destination.
And remember, market downturns can actually present opportunities to buy quality investments at a discount.
Oh, so they're not always bad.
No.
So try to view those dips as buying opportunities
Yeah.
rather than reasons to panic.
Now, one final piece of advice that I think is so crucial
Okay.
when it comes to personal finance
Yeah.
is to never stop learning.
Never stop learning.
The world of money is constantly evolving, and there's always something new to discover.
It's always changing.
I couldn't agree more.
Whether it's reading books,
Right.
listening to podcasts, attending seminars,
Uh-huh.
or simply talking to other people about their experiences,
Right.
never stop seeking out new knowledge and perspectives.
This deep dive into the psychology of money has been incredibly insightful.
It has been.
We've explored a wide range of concepts,
Mm-hmm.
from the biases that shape our decisions
Yeah.
to the strategies for building wealth and achieving financial freedom.
This has been really interesting.
But ultimately, it all comes down to making choices that align with our values and using money as a tool to create a life that is meaningful and fulfilling.
Beautifully put.
Remember, true wealth is not just about the numbers in your bank account.
Right.
It's about having the freedom to live a life on your own terms, pursuing your passions, and making a positive impact on the world.
So as you embark on your own financial journeys, remember to be mindful of the psychological factors at play
Yeah,
to define what enough means for you
define enough.
and to make choices that align with your long-term goals and aspirations.
And remember, the journey to financial well-being is a lifelong one, full of learning, growth, and adaptation.
A lifelong journey.
Embrace the challenges, celebrate the successes,
Yes.
and never stop striving to make informed, empowered choices
Informed, empowered.
that create a life of abundance and purpose.
Until next time, happy learning,
Happy learning.
and may your financial journeys be filled with wisdom and prosperity.
Wisdom and prosperity.